this video explains how to do the estate journal entries. So we don't have the chapter material that would show that. It is in a different edition, but this is what you're going to want to understand how to do on your test. And you'll also have one in your test review problems. But so here we have an example. Carolyn Hay died and she left a valid will. And then what is listed below is what's in her will. So those are all of her assets. She has bank accounts that are worth $36,000. She has some stock. She has some bonds. She has a condo, and then she has personal effects. So then the very first transaction that we do on the date of her death is set up the estate. So how we do that is we record each account. And the thing that we change with her bank accounts, the 36,000, that's going to go into what we call principal cash or cash principal. I guess I'm going to go back to the principal cash. Okay. Then we're going to have her stock. We value the stock at the date of death. So her common stock investment. So she has 17,150 shares. We don't care about the cost. We care about what the market value is. So then 17,150 times the $35 market value. That's the value at the date of the death. So we'll go ahead and make those numbers. Okay. Then it also tells us, though, there's quarterly dividends paid at $6,000 per quarter. So she would have already received her first quarter at the end of March. There would be 1 month that would be payable to her. So we can set up a dividends receivable. So again, it's $6,000 per quarter. So then that would be $2,000 per month. So then at the date of death, she would have already accrued that $2,000. So we'll put that in there. Okay, then she has IMA bonds also as an investment. And those, it tells us the face value is $100,000. It has interest being paid semi-annually at 6%. And then there's a current market value of $95,000. So we always want to go with the market value. So that's our value. But then we know that we're also going to have interest receivable. So we'll record that as well, again, up to the date of death. So up to the date of death, if it pays semi-annually and she died on May 1st, there would have been 4 months worth of interest. So then if we calculate that, the $100,000 par value times the 6% times, what did I just say, 4 months divided by 12. So $2,000 worth of interest we would know about at the date of death. And that we'd set that up as a receivable. I think I have an extra L there in my receivable. Okay. Then we come down and we have a condo that has a current fair market value of $250,000. And then we have personal effects. Valued at $25,000. So then that whole credit is going to go to estate principal. Our credit. It's going to be equal to all of those assets. Can I get that to do that? Oops. What did I do? I did something funky. All right, we'll delete that out. And then we'll just sum it. Okay, just so you know that those are the total of her estate. So her estate's a little over $1 million. Okay, so that sets it all up in the first place. Okay, then you're going to come in and look at these transactions. So then, again, we don't have dates on all of them. No, we do, on June 30th. So June 30th it tells us that the quarterly dividends were received. So when we get the cash in, it's going to go into principal cash. For the piece that we had set up as our dividends receivable, and then we're going to take it out of our dividends receivable. Then the rest of it, the remaining 4,000 is going to come into income cash, or cash dash income, whichever way you'd like to do it. So that'd be $4,000. And then estate income, because that they earned after she died. So it becomes money to the state. And sometimes people will will that out differently. So then that's why we keep track of it differently. Okay. Then we come down, and then the next transaction, they paid interest on June 30th also. So then the interest is the same way. So we get principal cash for what we had accrued up there for the interest. So that's $2,000. And then we take that out of our interest receivable that we had set up again when we very first set up the estate. And again, that's going to be a credit. And then the remaining 1,000 that comes in is going to go to income cash. And then estate income. And then the next transaction, we paid funeral costs, doesn't give us a date, so let's just say it's the same day. So then we would have funeral expenses. And that would be the 12,000, and that's going to be paid out of our principal cash. So everything is going to end up, any of those estate costs all get settled out of the principal cash. Okay, then legal fees, same deal. We'll do the same date for those. Legal expenses. And those are 5,000. And then those will also come out of the principal cash. Because again, they deal with settling the estate. Then her credit card payment, same deal. And that doesn't even really matter if you just want to call it final expenses, something along those lines, or as long as it's an expense that comes out of principal cash. And sometimes they even lump those all together, like with the funeral, the legal, and those final expenses all in one big kind of category. So I'm fine with that as long as it's an expense and we credit principal cash. Okay, then on July 1st, the common stock was sold. So when we sell it, we're going to get principal cash for the amount of the sale, which is $613,115. And then we're going to take it off of the book. So we go back up there and say, what did we set it up for? All right, so we set it up for $600,250. Again, that's a credit because now we are taking that stock off of the books. This one's the debit. And then now we sold it for more than it was worth. So then we have a gain. And the gain would be calculated by taking the proceeds minus the cost or the value at the time of the when the estate was settled. So there's a gain on the sale. Then on August 1st, we are going to sell the bonds plus interest. So we're going to get principal cash for $97,000. And then we're going to go up to the bonds and say, okay, what were those? We had them at 95,000. So it's going to be the same thing. We're going to have a gain on the sale for that difference. Now then the interest, we go back and look at that. What was it, $1,000 a month? And the last time they paid us was June 30th. So then that means we would have 1 month to record now. We earned the month of July. So then that would be income cash for the $1,000 and then estate income. Because again, it came in after the date of death. And then well, that's a debit. Okay, then finally, we distribute some of the legacies. So on August 15th, 500,000 is going to come out. So then we debit legacies distributed for the 500,000. And then we credit principal cash. And again, there'd be still, if we were really mapping this out, there's obviously still some money left over and there's still a condo. So there's still things to be closed. So they're going to get more later. But right now we're just taking it through that disbursement there. And then that's all. And that'll be similar to how the test question is as well.